Geopolitics has been one of the main areas of focus in the first half of the year. Obviously, there are some worrying military situations, such as the escalation of tensions with North Korea. But from an economic perspective, really investors started this year where they left off last year by focusing on what exactly Trump could deliver in the White House. Obviously, on his campaign trail, he promised a whole range of measures such as increased spending on infrastructure, tax cuts, some reform and regulation in the banking and healthcare sector. And all that pointed to a pickup in growth in the US this year. I'd have to say so far, few if any of those promises have become a reality. There is still hope that he can deliver, particularly on tax cuts and infrastructure before year end, and we may see a pickup in growth in the US toward 2018. I'd have to say as well, politics has also been clearly in focus on this side of the Atlantic. Following the shock Brexit result last year, Theresa May took a real gamble calling a snap election in the UK that did spectacularly backfire. She lost a majority in the Commons and lost really any hope of securing a stronger mandate for Brexit. The good news is, however, the election results may lead to a softer Brexit, which could be good for everybody. Perhaps the biggest political development this year has been in continental Europe. So Emmanuel Macron's victory over Marine Le Pen in France gave a real boost to stability in the Eurozone, and it went against populist results in the UK and the US last year. Looking ahead to the rest of this year, Europe will remain in focus. Brexit negotiations are only getting underway, and in October this year we have German elections where Angela Merkel is looking to secure her fourth term as Chancellor in Germany. Despite a lot of political uncertainty, the good news is the global economy is in the best shape it has been since the global financial crisis itself. For the first time, we are seeing a synchronized global economic expansion. All major regions are moving in the right direction, and leading economic indicators are all moving higher. In the world's largest economy, the US, we continue to see jobs being created. Consumer and business confidence are at a cyclical high. Unemployment has now fallen to 4.4%, with over 15 million jobs created since 2010. What we would say, however, is that the biggest surprise has come from Europe after many years of stagnation. The European economy looks as if it has finally turned the corner. Again, we're seeing an improvement in the labour market. Consumer confidence is picking up. We're seeing everything from retail sales to auto sales increasing, and that augurs well for growth in the world's second largest economy in the back half of this year. On the back of the better economic data, central banks have turned a lot more hawkish in their comments. The Federal Reserve raised interest rates for only the third time in 10 years during the second quarter. This obviously means that they feel confident enough that the US economy is strong enough to withstand higher interest rates, and they can get back to some type of normal monetary policy. On the back of better economic data out of Europe, the ECB has also signalled that they will start to unwind their quantitative easing programme early next year. We still think that rate hikes are some way off in Europe, but there are growing calls, particularly from within Germany, that rates are far too low at the moment for the growth out of the Eurozone economy. In the UK, the Bank of England really is caught between the crossfire of rapidly rising inflation due to the collapse of sterling and an economy that is really decelerating quite sharply in the wake of Brexit. In fact, at a previous meeting, the MPC voted to keep rates on hold, but 3 of the 9 members actually voted to raise interest rates to help dampen that inflation. The other 6 members obviously are resisting the temptation to raise rates in the hope that the inflation pressures are transitory and are primarily due to the valuation of sterling. There have been several significant implications for financial markets. On the one hand, the stronger economic growth is translating into stronger corporate profits, which is helping to push equity markets higher. But the prospect of rising interest rates is pushing bonds lower. But probably the main implication for investors has been the move in the euro. If you think back to 2014, the euro was worth around 140 of the dollar, but it started this year below 105. Since January, we've seen the euro strengthen, and it's up as much as 9% against the dollar in the first half of the year, and today it's trading around 114. Looking ahead, if, as we expect, the ECB end quantitative easing and the Federal Reserve undertake just one rate hike before year end, we do think we could continue to see that trend continue and for the euro to continue to claw back some of its losses. The OECD measure fair value in the currency pair around 130. Now, we don't expect the euro to get as high as that, but certainly if the conditions transpire, such as the ECB ending quantitative easing and the Federal Reserve raising interest rates only once, we do think it's probable that the euro will break out of this current trading range and we could see it move towards 120 before year end.
It's been a case of mixed returns for asset classes year to date when we look across the world. Within equities, it's been a broad-basedly good half of the year. We've seen that from Europe and the US to further afield. Within fixed income, it's been a more spread. We've seen lower or slightly negative returns in Europe and slightly positive in the US, but that's lower returns versus previous years as investors are preparing for a change in interest rate policy. In Europe, that means reduction of QE. In the US, that's further interest rate increases. Within commodities, oil has dragged that return lower. Notwithstanding OPEC's efforts to reduce production, we've seen lower returns there. I suppose the major issue for euro-based investors has been the impact of strengthening euro. That's limited the returns available for investors year to date. Equities have been the key driver of portfolio returns on a year-to-date basis, with all geographies showing strong returns on a year-to-date basis. Within Europe, initially it was the companies focused on exporting and had benefited from a reduced exchange rate that were supportive. But furthermore, we've seen increased consumer strength across the continent, which has led to a broader-based recovery. Within the US, it's been large cap companies to the fore, which have delivered strong returns across a number of sectors. But broader in the US and Europe, we've seen strong returns in the UK and Japan, and interestingly, emerging markets have delivered for the first time in a number of years. Equities have been the primary driver of returns within portfolios on a year-to-date basis. We've seen that come across a broad base of sectors and geographies, but specifically to the calls that we have open in portfolios at present have delivered very good returns. That's the allocation that we have to healthcare and technology. Both sectors have valuations that we consider to be undemanding and also benefit from significant trends and tailwinds into the broader economy. From technology, that's the proliferation into everyday life that everybody is aware of. And from healthcare, it's very significant demographic challenges that the Western world is going to face. As would be expected from the returns of asset classes for the year to date, we've seen low to mid single digits returns on a year to date basis for portfolios. But once we broaden that out on a rolling basis over a 1, 3 or 5 year return period, we're seeing client returns much more in line with their medium to long term objectives, which is our key focus here for clients. At this point in the cycle, it's important to remember the level of risk clients are taking and how you're investing your funds, and to ensure that you're not taking excess risk at this point in the cycle.